Imagine this. You're sitting at a poker table, your heart pounding. Then the guy next to you, calm, confident, leans in and whispers, "Trust me, play this hand, it's a winner." Something about the way he says it, so sure, so convincing, and against your better judgment, you go all in. And just like that, you lose everything. Now pause for a moment. Was he lying to you? Or did he actually believe what he was saying? This is exactly what happens in trading every single day. The markets are filled with sentiments, truths that sound smart, feel right, and get repeated by everyone, but are nothing more than costly illusions. If you've ever followed bad advice thinking it was the secret to success, you might be making the same mistakes over and over without even realizing it. Don't stress. We've all been there. We've all made that mistake of following advice that sound good, but are actually bad for your trading bank health. Today, we're discussing 5 more of these trading psychology mistakes that almost all traders make. The trading psychology mistakes that quietly drains trading accounts. This video is sponsored by WikiFX. More on them later in the video. Without wasting your time, let's get to it. Mistake number 1. Believing that the more capital you have, the more you'll profit. Just throw more money at your trades and you'll get richer, right? Well, you'll soon find out it doesn't quite work like that. Let me tell you about long-term capital management, the hedge fund that had everything going for it. Founded by Nobel Prize-winning economists and Wall Street's brightest minds, LTCM started with $1 billion in capital and leveraged it into $100+ billion in bets. Their strategy was simple: arbitrage trades that were mathematically guaranteed to win. And for a while, they did win big. 40% annual returns, massive profits, and a reputation for being untouchable. With that much money and brainpower, they basically thought they'd cracked the market's code. Then 1998 happened. Russia defaulted on its debt, an event LTCM's perfect models never saw coming. And suddenly, their can't-lose trades started losing. Fast. $4.6 billion vanished in weeks. The fund imploded so badly that the Federal Reserve had to step in to stop a full-blown financial crisis. As a beginner too, I thought more capital meant better returns. And if you've ever made the mistake of believing the same, you're not alone. The bitter truth is, more money doesn't make you a better trader. More money doesn't mean smarter trading. In fact, it can make things worse. I learned this the hard way when my first $100,000 prop firm account was blown in days. And it wasn't because I didn't know how to trade, but because I wasn't ready to handle that level of capital. I have had success with smaller accounts, but scaling up exposed weaknesses and emotions I didn't even know I had. Think about long-term capital management. They had billions, yet they ignored risk, and it wiped them out. On the other hand, smaller traders who respected the market survived. They adapted instead of assuming they were untouchable. This is why so many traders fail. They believe throwing more money at a bad strategy will fix it, but it doesn't. The market doesn't care about your account size. It only cares if you know how to play the game. A skilled trader with $500 can and will most likely outperform an amateur with $50,000. Because knowing when to enter, when to exit, how to manage risk, and most importantly, managing your emotions, is way more important than just having a big account. The secret is to focus on mastering yourself first, understand the beast called the market, then scale up accordingly. Mistake number 2. Thinking that someone else's strategy will work perfectly for you. If success in trading was as simple as copying a proven strategy, why isn't everyone rich? You've probably seen it before. Some self-proclaimed expert swears that their exact system can transform you into a millionaire. Just follow these signals, use this strategy, and you'll print money. But history tells a different story. In the 1980s, legendary trader Richard Dennis set out to prove a radical idea. Is trading success about natural talent, or can anyone be trained to win? So, He created an experiment. He recruited a random group of people, some with zero trading experience, and taught them a strict, rule-based, trend-following strategy. These traders became known as the turtle traders because, according to Dennis, traders could be trained just like turtles were farmed in Asia. The idea was simple. If the system was good enough, everyone should succeed. Each turtle trader followed the exact same entry and exit signals, risk management principles, and position sizing rules. No guessing, no personal discretion. Just follow the system. Yet, when they put it to the test, a few, like Jerry Parker, became legendary traders, making hundreds of millions. Some barely broke even. Many completely failed. Some blew up their accounts. Others quit after a string of losses. So, if the system was the same, why did the results vary so much? Well, here is why it didn't work for everyone. Psychological differences. The system had strict rules, but when massive drawdowns came, only a handful had the mental toughness to stick with it. Others panicked, deviated, or gave up. Market conditions changed. The strategy worked great in the 1980s, but by the 1990s, markets had evolved. Traders who adapted survived. Those who didn't failed. Execution wasn't identical. Even small variations, hesitating on a signal, mismanaging risk, or entering a second too late, created vastly different outcomes. A strategy is only as good as the person executing it. Even a perfectly backtested, mathematically sound system can't protect you from your emotions when losses pile up. Your discipline, or lack of it, when you're tempted to tweak the rules, your ability to handle long losing streaks without giving up, all come into play. The lesson for traders is simple. If a mechanical, rule-based system couldn't guarantee success for everyone, why would a vague strategy from an online guru work for you? The truth is, no one-size-fits-all system exists. Trading is deeply personal, and your personality affects how you trade. Your risk tolerance affects how long you hold, and your discipline determines whether you follow the plan or sabotage it. If you copy a strategy without understanding how it works, testing it for yourself, and adapting it to fit you, you're setting yourself up for failure. It's not about finding the perfect strategy. It's about becoming the trader who can execute one with discipline, adaptability, and confidence. And speaking of confidence, how confident are you that your broker is legit? Scams in the trading world are everywhere, and blindly trading with or following signals from a bad broker can wipe you out faster than a bad trade. That's why WikiFX exists, to protect you and I from these scams. WikiFX is a globally recognized platform dedicated to providing transparency and security in the Forex trading industry. With over 65,000 brokers analyzed across 30-plus countries, regulation checks and risk assessments, so you know who's legit. Real trader reviews exposing scams before they trap you. Live market insights and expert strategies to help you trade smarter. Don't trust blindly. Before you trade, verify with WikiFX. All you have to do is click the link in the description or pinned comment to get started. But please, do that at the end of the video. Now, back to the mistakes. Mistake number 3. Believing that a secret indicator guarantees profits. In June 2021, Bitcoin's price chart flashed the dreaded death cross, a technical indicator where the 50-day moving average crosses below the 200-day moving average. For decades, stock traders viewed this as an ironclad sell signal, and crypto analysts assumed it would predict Bitcoin's next crash. Financial media jumped on it. Bitcoin's death cross confirmed. Massive crash incoming. Twitter exploded with fear. BTC is doomed. Short everything. Even so-called experts declared, this is mathematical certainty. Traders rushed to short Bitcoin, convinced they had a foolproof trade. What actually eventually happened was, instead of crashing, Bitcoin ignored the death cross and skyrocketed 300% over the next 6 months, peaking near $69,000. Those who shorted based on the guaranteed indicator signal got liquidated. Even when the death cross reappeared, Bitcoin rallied afterward. Secret indicators are a trap. Markets don't follow old rules. What worked years back don't necessarily apply today because the game will always change. Indicators react to the past, not the future, and by the time a signal appears, the big players have already moved. And you also have to know that narratives matter more than patterns. In 2021, Tesla, MicroStrategy, and inflation fears fueled Bitcoin's rise. No technical signal could override real-world momentum. The lesson is simple. In trading, context always wins. The death cross didn't signal doom. It became a contrarian buy signal. Indicators can be useful, but they don't replace experience, market understanding, or risk management. Successful traders don't rely on one tool. They read the market, adapt, and think beyond the charts. The brutal truth is there are no guarantees in the financial market. If there's a secret indicator that worked, there would be no losing traders, and everyone would be rich. Indicators are just tools, not magic wands. Stop making the mistake of thinking that they are. So, next time someone promises a foolproof indicator, ask them, how did that death cross work out? Mistake number 4. Believing you can just follow signals to make money. Just trust the signals. Sounds easy, right? Well, in 2008, investors thought the same. Mortgage-backed securities, MBS, were stamped AAA rated, supposedly as safe as U.S. Treasuries. Banks, hedge funds, and pension funds blindly bought in, believing the rating agencies had done their homework. But beneath the surface, these securities were filled with toxic subprime mortgages. The rating agencies weren't neutral. They were paid by the banks selling the products, and no one questioned the signals. Then came the collapse. Lehman Brothers imploded. Investors lost billions, causing the global economy to crash. Meanwhile, traders like Michael Burry and John Paulson, who actually studied the mortgages instead of trusting the ratings, bet against the system, and they made billions. Why just following the signals is a mistake. Many traders believe that following trading signals will lead to easy profits, but this is a dangerous misconception. Signals often lack context, meaning they don't account for economic events, market sentiment, or institutional activity, all of which can override technical patterns. Market conditions also change constantly, making any fixed signal strategy unreliable over time. A trend-following signal, for instance, might work in strong uptrends, but fail in choppy or ranging markets. Also, many signal providers sell false promises, advertising high win rates, while using deceptive tactics like hindsight bias or martingale strategies that lead to eventual account blowouts. If signals were truly profitable, providers would trade them instead of selling subscriptions. Most importantly, relying on signals prevents you as a trader from learning essential skills like market analysis, discipline, and strategy adaptation. Successful traders don't blindly follow alerts. They develop independent thinking, adjust to changing conditions, and prioritize risk management. In trading, knowledge and adaptability matter far more than any magic signal. Mistake number 5. Believing you can predict the market. It's a calm morning in June. You wake up, stretch, and settle into your routine. The charts are open, and everything looks perfect. The trend is strong, the setup is textbook, and a quiet confidence takes over. The market is climbing, steady, predictable, unstoppable. Everything feels certain. Why would you doubt it? In this moment, would you ever think the market could crash so badly? If your answer is no and believe the market can't turn in an instant, let me remind you just how quickly certainty can vanish. Back in early 2020, every major analyst and economic indicator pointed to stability. The S&P 500 was hitting record highs, unemployment was at historic lows, and Wall Street was gearing up for another year of steady growth. Then, in an instant, everything collapsed. Within 3 weeks, global markets crashed over 30%, marking the fastest bear market in history. Oil prices turned negative for the first time ever. The VIX, Wall Street's fear gauge, shattered records, even surpassing 2008 financial crisis levels. No model, no prediction, no algorithm saw it coming. Even disease experts underestimated the COVID-19 impact. As late as January 2020, the World Health Organization insisted there was no clear evidence of human-to-human transmission. If the world's top epidemiologists missed it, how could traders have foreseen the financial chaos that followed? Traditional indicators failed, too. The Federal Reserve's stress tests, meant to predict financial disasters, never accounted for entire industries shutting down overnight. Even supposed safe haven assets like gold and bonds collapsed alongside stocks. Yet, just as unpredictably as the crash, the rebound defied all logic. Tesla skyrocketed 10x. The Nasdaq doubled. Even Hertz, a bankrupt company, rallied 500%. The same experts who never saw the crash coming also missed the recovery. At the time of writing this, Trump's tariff policy is the wild card in the market. Its impact is uncertain, and no one knows which direction it will take us. Market movement doesn't come with clear warning signs. The next major shift, it'll come from where no one expects. If you think diversification guarantees safety, well, it is not always the case, because when real uncertainty takes over, everything, stocks, even so-called safe assets, can move unpredictably. So, what's the only real protection? The true answer is humility. No analyst, algorithm, or central bank can predict the future with certainty. The best traders aren't the ones who believe they have it all figured out. They're the ones who know they don't. Because if the biggest global crisis in decades blindsided the world, what makes you think you'll always anticipate the next move, or even what the market will do in the next hour? If there's one thing truly predictable about the market, it's this. It humbles anyone who thinks they've mastered it. That's why risk management isn't optional. It's the only certainty. The trading world is a maze of illusions, lies wrapped in truth, myths sold as wisdom. And if you missed the first video where I exposed these illusions, clicking the linked video is what you need to do, because you've only scratched the surface. The trading psychology deceptions run deeper than you think. But there's a place where we go beyond the surface, a space where trading psychology, raw market insights, and real strategy come to life. My Telegram channel. It's where I share what I can't fully break down here on YouTube. A space for traders who want to think differently, challenge the norm, and sharpen their edge. The link is in the description of this video. If this video sparked something in you, please let me know in the comments. Also, don't forget to like and subscribe so you don't miss videos like this in the future. Thanks for watching, and until next time, stay sharp, stay nimble, and may the trend be in your favor even though you can't predict it.